Alphabet or Google stock just reported a monster first quarter 2024 earnings. You can see sales growth has accelerated. That is what investors love to see. From 3% last year to 15% this year. Operating margins jumping from 25% to 32%, reflecting that management is indeed serious about managing their costs. You see earnings per share jumping from $1.17 to $1.89. These are the results that investors love to see. A monster quarter from Google. And then what is this? They talk about the initiation of a cash dividend program, paying a cash dividend of 20 cents per share per quarter. And this follows in the footsteps of Meta announcing a dividend in the past year. They also talking about re-upping their share repurchase program to $70 billion. This is an additional $70 billion that they're announcing today. What is going on? I mean, has the Alphabet management found religion rewarding shareholders? What's going on? Okay, if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. So the initiation of a dividend is actually a big deal because it's their way of signaling to investors, no matter what challenges we face, we are going to generate enough free cash flow to be able to keep paying you in the future. That's our level of confidence. Now, it's not like they're paying all their free cash flow. They're still paying arguably more of it in the form of a buyback. And it's only currently, less than a 1% yield, like closer to, I think, 0.5% yield in terms of dividend. But it does reflect management's confidence in them saying, we believe we will do fine. And we have the balance sheet to do fine. And despite the concerns about this AI revolution, and despite the concerns that we have 90% market share in the search market, and maybe that comes under pressure over time, we will survive. Not only will we survive, we will grow. So that is an important psychological impact for shareholders, that they're effectively signaling. From an actual dollars return perspective, it's not going to dramatically move the needle. What really moves the needle is when they do compelling buybacks, when the stock price is at a much lower or even a more compelling valuation. That's what juices your returns. This sort of dividend, it's more of a psychological aspect. I personally think it reflects that they haven't really studied under the school of Buffett, which is that, hey, you don't need to offer a dividend if you prove that you're an exceptional capital allocator over time. They have, I'd argue, proven that with some of their past acquisitions, but currently I look at it and I think this dividend is a nice initiative. I don't view it as truly transformational, but it can result in some additional buying. It is worth calling this out in that there are some investment funds that can only buy some like income-driven investment funds that previously couldn't buy Google, but now they could because they could say, oh, well, it's a dividend payer, and that you have some dividend restricted paying, institutions that say, hey, we only invest in stocks that return their free cash flow to you via dividend. So this does open up the potential pool of buyers. So not surprising to see the stock jump in the after hours, jump at a teens percentage, up around 13, 14, 15% in the after hours. Not fully surprising. Let's dive deeper into their results because broadly, this was fantastic results. You see Google search and other up 14%. So the ad market still clearly taking market share in the Google search and other business. And this is, powering billions of users on a daily basis. YouTube ads, not abs, doing fantastically, up 21%, still rapidly taking market share as well in terms of viewing hours. And there's been various different, indicators that show that YouTube, arguably it's YouTube, Netflix, possibly Disney Plus, they're kind of like the top three contenders. Really, it's YouTube and Netflix that are like, we are winning the streaming wars in terms of taking share over time where people just love it. And this is a go-to. So I look at YouTube and their success here. I look at the initiatives, what they're constantly doing. They're experimenting with, shorter and shorter, the stories on YouTube. I think that this continues to win. And by the way, with the AI revolution, YouTube ads is in a fantastic position because AI tools make it easier and easier for people to create new content. So I think you're going to see a lot more storytelling that's just incredible uploaded to YouTube. So YouTube will become a source for discovering new creators in a way that's really incredible. And by the way, I mean, here it is. You're watching Unrivaled Investing. It's on YouTube as well. So the next one is Google Network. This is, impacting or helping the third-party websites, clearly not taking market share, clearly struggling with a 1% decline year over year. I've called this out now for a couple of quarters that this business line just really isn't cutting it. It's not doing that great. It does suggest that the marketplace does have some other winners in terms of if you are a business that's enabling third-party websites and their advertising revenue, you're likely taking share from Google, given that here it is, you're seeing this 1% decline. That said, it doesn't mean that they're a loser. It just means this one line of business, they're not winning. The search and YouTube's ad business, they are crushing it. Advertising broadly growing 13%. It is worth also contrasting this with Meta, which posted 25 or 27% revenue growth. So, their advertising business is clearly crushing it, rapidly taking market share. That is a very favorable data point for Meta as you think about it. I did a prior video on Meta just earlier today. I'm coming back from spring break in full force, looking at their subscriptions platform devices segment. That is up 18%. So this was a highlight during the call. The call is ongoing right now, but one of the key points is the subscribers effectively tuning in to their premium subscriptions, whether or not it's to get access to, getting cloud type of offerings, individual consumer offerings that, they're seeing a favorable subscription. Like I personally have an Android phone, and that if I want to make sure I have enough space, you subscribe and you pay a couple bucks per month to make sure you have enough storage. So you are seeing various different subscriptions continue to do well. You're also seeing their actual cloud segment doing very well, up 28% year over year. I mean, I believe this does reflect that, they are taking market share. You're looking at AWS, I believe, growing a little bit slower. So they're still a lot smaller than, let's say, Amazon's AWS, but 28% growth is attractive. Broadly, 15% revenue growth. This is what investors like to see. It's incredible that a company with $80 billion in revenue is, still growing at this type of pace. And to show that management is serious about their costs, their total acquisition in terms of their customer costs up around 10%, and the number of employees was actually down 5% year over year. So this does reflect, wow, this business can get incredible leverage when you can grow 15% and cut 5% of your workforce in the same period. So margins for Google can explode. The question is, where does Alphabet go from here? I walked through a couple of the dynamics going on with this business. First of all, in full disclosure, this is not financial advice. Also, just earlier today, A. Woods, a premium member of the Unrivaled Investing community, shared the following. This was on our exclusive Discord. This is a direct quote. Prior to Unrivaled Investing, I was yielding around average or below average market returns. Post-membership, I've tripled my investing returns and have crushed the market with much lower risk. Thank you, Daniel, for your insights and your approach to investing. It has helped me improve my investing mindsets and returns. I'm currently ahead of my investing goal to retire at age 45. Thank you very much for the very high praise. That's a direct quote. You can see more if you decide to join at unrivaledinvesting.com. We have our exclusive Discord server. We also have educational materials at unrivaledinvesting.com if you're interested in, let's say, learning how to read financial statements or learn how to value stocks as well. And so what do I think about Google right now? One of which I called this out with Meta as well, which is that banning TikTok, unless it's, sold, which is possible. Either way, I think Google's a winner. And folks might not fully understand this because I got a question about that on the Meta video, which is that the reason why Google's a net winner is the way these advertising businesses work is it's about the number of ad impressions and the dollar that you can charge per impression. So if you effectively ban a platform that has hundreds of millions, if not billions of users like TikTok, I think it's hundreds of millions, what you're really talking about is people then saying, okay, I'm no longer seeing this. Where am I going to spend my time? And if you're spending your time on increasingly, let's say on YouTube to watch your short form videos versus TikTok, you're going to have more impressions on YouTube. So therefore your advertising revenue will pick up. There's also a theoretical possibility. I think it's fairly low just given how backwards the the FTC policies have been in terms of blocking various deals. But I mean, there is a remote possibility, I'd imagine, that Google could even potentially buy TikTok if they wanted to. I mean, they have 100 billion plus on the balance sheet, so I think they could, plus the free cash flow. But I realistically don't think that that's in the cards. But either way, TikTok's loss, I think, is the gains for Google, YouTube, and Meta. And so, and I think this is also a win for society as well, because there's a lot of people that I believe have been brainwashed by some CCP leaning on the scale here, but that's a whole other conversation. That said, Google isn't out of the woods completely. I mean, let's be honest. Just recently, Perplexity raised over $250 million, valuing it at between $2.5 and $3 billion for its AI search platform. Customers and investors are very excited about this. And this includes Jeff Bezos, Sequoia, Meta's chief AI scientist, Jan LeCun, Susan Wojcicki, who used to run YouTube. This is the former CEO of YouTube, Stanley Druckenmiller. He is one of the best investors out there. Y Combinator head, Gary Tan. These are some very, very prominent investors backing Perplexity, effectively saying, look, the traditional search model could be disrupted by this company, Perplexity. I've used Perplexity. It's a very good product. I recommend you try it for free. You know, there's no any sort of relationship I have with Perplexity. Just for your own curiosity, give it a shot. You know, there's no incentive for me to call this out. I'm just sharing it because it does reflect that the industry is changing. That said, Google is staying on top of it in the sense of saying, hey, we're actively, and they called this out during the call, they're actively rolling out, you know, their own generative AI search experience. So that way you're increasingly getting it. And they've successfully managed it so far with their costs. That was originally a red flag for me because search, you know, generation results is much lower cost than AI generation. And so AI generative results. And so I was worried that you could start seeing a real hit to margins. You're just not seeing that. They so far have been threading the needle very well. And I'd argue the revenue growth that you've seen with search and with YouTube ads suggests that they're doing fine at this point. So this is a threat, this Perplexity threat, the threat that, you know, Microsoft talking about how they want to make Google dance. This threat is in the environment. It's for investors to be aware of, but so far it's not showing up in the results. And management, I think, is focusing on the right things. For example, when their, you know, Gemini AI was generating highly woke images, you know, what did the CEO say? Did he say, "Oh, this is totally fine, and I'm really glad we're talking about this uber progressive agenda"? No, he said this is completely unacceptable. He said we got to fix this, and this is going to be a theme that I think we're going to see increasingly with AI, which is sometimes AI might call out aspects of humanity that we sort of hope to sort of ignore, or that we create our own sort of theoretical frameworks of like, oh, well, this is why it is. But AI can say like, look, here's the data. This is how it is. It might not be comfortable for some people to see. And so that's, I think, this new era that we're going into, where, you know, it hopefully is calling out truth, and it, you know, humanity sort of has to question and reflect on it. Another example of Sundar Pichai, you know, talking to employees saying, hey, get real, stay focused, is that he doesn't want any more political debates in the office after firing 28 employees who stormed one of the offices, the GCP offices, over an Israeli contract protest. So it's like, look, let's focus on business. We are a for-profit company. Let's deliver results. Let's drive amazing results. When I asked AI Ticker Chat, which leverages artificial intelligence to analyze the business, we have Scorecard, which now analyzes the quality of the business. We also, one of our legacy products is AI Predict, that provides a quantitative framework. So this is looking at the quantitative. You can check out the qualitative yourself. You know, you can use a AI Ticker Chat. First month is free. See the link below. Looking at the quantitative assessment, it's effectively saying 50 to 150% upside over time, depending on, you know, what sort of growth you want to assume in the years ahead. You know, what type of margins, what type of N multiple. It is a little bit of a higher multiple than I'm personally comfortable giving, just given the uncertainties in the environment. But broadly, it's, you know, a very reasonable take. When I run Google or Alphabet through my own framework, I'm effectively getting something that's a little bit less optimistic, but still very reasonable. This is a hypothetical valuation framework, effectively suggesting that if they execute, maybe you're talking about somewhere between a 10 and let's say 20% type of return over the next 5 years, looking at the various different pieces of this business. So overall, I look at Alphabet, even after it's run up, saying I think it's still very reasonably valued. I don't view it as, like crazy expensive or crazy cheap. I view the company as executing very well. I view the risks to their business model have increased. That said, so far, they're navigating it very well. And arguably, it's too early to say that, some of these competitors are really making a dent. It's something to watch out for. That said, I think the threat of AI hurting their margins, we really aren't seeing at this point. In management, by initiating this dividend and, showing that they could cut employee costs, cut employees by 5% while growing revenue, suggests that they are laser focused on improving their profitability, even if they're in a new AI-driven era that could actually result in higher costs per search. So these are all broadly favorable developments, including the TikTok. I could probably use a TikTok right now. No, the TikTok ban. I think that's also going to be favorable for them. That said, that'll be over a several quarter perspective. If you enjoyed this educational video talking to you about Alphabet, please make a point of hitting that thumbs up, hit that subscribe button. You are watching Unrivaled Investing. Thanks so much for tuning in.